There is this basically universal celebration across the entire real estate universe when the Fed cut the federal funds rate a couple of weeks ago at their September meeting. And people were getting excited because after this move, they were expecting lower mortgage rates. And for a very brief moment, it just feels like a single minute that was actually true. Rates dropped to about 6.1% for a 30-year fixed rate mortgage on September 11th. And after that happened, there was all sorts of people rushing to refinance, to get their purchase applications for mortgages in. But if you blinked or hesitated at all, you probably missed it. Because since then, rates have climbed back up to over 6.5%. And I think I speak for all of us in the real estate industry in saying that we want to understand what is going on with these mortgage rate roller coaster and what is going to happen next. And I want to give it to you all straight, and this is a bit of a spoiler, but I think people are generally being a bit, or actually really too optimistic about mortgage rates right now. So in this video, I'm going to tell you a little bit about what's happened over the last couple of weeks, why I'm personally sticking with my original mortgage rate forecast for the year, because so far it's been right, and how you should plan out the next few months if you're looking to jump into the market. Hey everyone, it's Dave Meyer, head of real estate investing here at BiggerPockets. I've been investing for 15 years, housing market analyst for 9. And although no one knows exactly what's going to happen with mortgage rates, I think I have a pretty good grip on the variables that go into mortgage rates. And I'm going to explain that all now to you today so you can understand where rates are probably going for the rest of this year and into 2025. So let's get into just the basics of mortgage rates. You may have heard me say this before, but the Federal Reserve, although we love following them and every word at their press conferences, they actually don't control mortgage rates. They control something called the federal funds rate. Mortgage rates are actually much more closely tied to bonds. And if we're talking about the 30-year fixed rate mortgage here, which is the most common residential mortgage, that is most closely tied to the 10-year treasury. And so when we look at where mortgage rates are, what's happened, and where they're going, we have to understand where yields on treasuries are going. And that comes down to the very mercurial and unpredictable behavior of bond investors. See, bond investors, they're interesting folks. They are not like real estate investors who are buying a physical asset. What they're trying to do is basically bet on the future of interest rates. And things like recessions or inflation or geopolitical instability are how they bet on future interest rates. Things like recessions make them invest more in bonds, right? Because a recession is an inherently risky time for all investors. And so when you're managing a hedge fund or a pension fund, that's what a lot of bond investors are, when there is risk in the broader financial system or the broader global economy, they want to move their money to safe things. And bonds are generally seen as safe. And so when recessions are feared, or people think there's a recession coming, or they're in one, more people want to invest in bonds. This in turn creates demand for bonds. More people want them, and that drives down the interest rate, or quote unquote yields on those bonds, right? Because the government, they issue the bonds, and when a lot of people want to lend money to the government doesn't have to pay as high of an interest rate. So that's one reason why bond yields go down. On the other hand, when there's inflation risk, bond yields actually go up because these investors are lending money to the government. That's basically what a bond is for the next 10 years. And for them, if inflation picks up, perhaps say higher than the yield on the bond, that could be really risky for them because they would be losing spending power and losing money in real terms. So bond investors are basically looking at all these variables and betting on what's going to happen in the future. So the question is, now that we understand that, what is driving up yields right now? Why are bond investors less interested in bonds today than they were a month ago? And remember, because they're less interested in bonds today, yields are going up and they're taking mortgage rates up with them. So again, why are mortgage rates going up? The first reason is the recent jobs report. We had a jobs report that came out for September that was much higher than expected. And in the minds of bond investors, that means there is a reduced risk of recession, right? We were expecting to see the unemployment rate go up, that the US economy added fewer jobs than in previous months, but actually the opposite happened. The unemployment rate actually just stayed steady, but there was far more jobs added to the economy, and that was unexpected. And so this new news, this new economic data, basically incentivizes investors to move away from low risk assets like bonds because they were thinking, oh, there's going to be a recession, so we're going to put our money in bonds. And now they're thinking, oh, actually, there's less risk of a recession. I'm going to put my money into higher risk assets that have a better opportunity to grow, for example, like the stock market. And we can see this directly in the bond yields, right? We see the jump in yields starting on October 4th when that jobs report came in. And I do want to take just a minute, a side note here, because every time I talk about jobs data, people point out to how labor data is bad and they're constantly revised. And some of those things are true because every data point has its strengths and weaknesses. Jobs reports are constantly being revised. But regardless of what you think of this data point, this is what these major bond investors are watching. And these, again, are the people who really dictate mortgage rates. So if you want to understand what's going on in the economy and where mortgage rates are and are going, you should be watching this data point too. So that was the first thing that drove up yields, which was this jobs report. The second thing is actually really interesting, and it's about this persistent inflation risk. Because first of all, now that the Fed is cutting rates, that could reignite inflation, right? They pushed rates up to fight inflation. They're doing all right on that battle, not at their goal yet, but they've already started cutting rates before they reach their goal. So there is some fear that inflation could reignite just from that alone, and that could drive up yields. But also, we have this big problem in the United States, which is our enormous and growing national debt. And when we have high debt, there is this temptation to print money, like the government should just print money to make that go away. They're actually not doing that at the current moment, but I think of a lot of investors see debt continuing to rise and think that there is going to be inflationary pressure for the foreseeable future until our debt starts to get under control. And actually, just this morning, I was reading an article in the Wall Street Journal about how bond investors and investors in general are worried that regardless of who the next president, who wins the election, either one is going to add to the deficit through a combination of spending and tax cuts. There's actually a committee for a responsible federal budget, and they have estimated, this is a nonpartisan committee, they have estimated that if Vice President Harris wins the election, the national debt will grow by $3.5 trillion. And if former President Trump's, it's actually estimated to be higher at $7 trillion. And at points, we're talking about these enormous sums of money, so it almost feels like play money. But either way, we're talking about enormous increases in the national debt, regardless of who is expected to win, because both candidates are basically promising spending, increased spending, and tax cuts. And those things are going to add to the debt unless they come up with some way to pay for it. And at least according to the Committee for a Responsible Federal Budget, neither candidate has done that yet. And so these things combine, both the lower risk of recession, given recent jobs data, plus the high probability of an increasing federal debt, means that interest rates are probably going to stay higher for longer to combat that inflationary risk. And I know I am a broken record, but I have been saying this for a while, that I don't think these optimistic opinions about mortgage rates going down into the 5s or perhaps even to the 4s are accurate. It could happen, but I don't think that is the most probable outcome given everything we're seeing right now. So the question is, what happens next? And I will share my thoughts with you in just a minute, but first, a word from today's video sponsor, Vacasa. The dream of owning a vacation home, it can be daunting. From finding the best guests, to the maintenance, to organizing the cleaners after every guest stay. But with Vacasa, they make that dream into a reality. As a full-service home management company with vacation homes in key destinations across the US, they know a thing or two about how to make owning a vacation home easy and profitable. On top of proactive property maintenance visits by professional local teams, a hospitality-driven booking platform, and around-the-clock support, Vacasa earns homeowners on average of 20% more revenue from their vacation homes. Vacasa is always thinking of ways to simplify the vacation home owning experience by putting your home to work for you. So if you're looking to make more from your vacation home, work with a reliable property manager, and finally have peace of mind, partner with Vacasa at vacasa.com/BiggerPockets. That's vacasa.com/BiggerPockets. All right, so back to what this means for mortgage rates. For the rest of the year, I think we're going to see a lot of volatility, and I don't expect mortgage rates to go below 6%. I would be a little bit surprised at this point if we see it become below 6.1%, which has been the low for 2024. Hopefully it will come down a little bit, but I just don't see some of the fundamentals, and honestly, the fundamental lack of clarity that's going on in the market. And until there's clarity, I don't think we're going to see meaningful movement in mortgage rates. As we look towards 2025, I do think there will be some downward pressure on mortgage rates, but I got to say, I don't think we're going to get all that much relief unless the labor market gets much worse. And there's no assurances that would happen. I think there's a chance that we see rates into the fives next year, but I would put the lower bound on mortgage rates for 2025 at 5.5%. Of course, that could change, but as we look at the data that we have here in October of 2024, there's just not a lot of evidence that mortgage rates are going to move much lower than where they are right now. And yes, 5.5 would be a significant improvement over where we are now at 6.5. But if you're counting on a bigger leg down than that, I personally wouldn't do that. And I know that's a disappointment to a lot of people in the real estate industry, but I want to give it to you straight. I personally don't think we're going to get enormous relief from mortgage rates, at least in the next 6 to 12 months. So as an investor or a home buyer, what do? Well, I expect, like I said, a lot more volatility. We're going to see mortgage rates going up and down, probably in this mid to low 6 range for the next couple of months. Because it seems like every day there's some news or some new economic data that sends mortgage rates moving in one direction or another. And so you don't want to time the market, but if you see a leg down and you start to see mortgage rates at 6.2, 6.1, even 6.3 at this point, you may want to jump on that because prices in the housing market are still going up. So waiting and hoping at this point that mortgage rates go even lower may not even result in better affordability, because if mortgage rates are just going down slightly, but home prices are going up slightly, it may be a wash. And so if you see an opportunity to buy a deal that makes sense with today's mortgage rates, you may want to jump on them when you see some positive trend, even if it's little, because since we don't know what's going to happen, that might be the best mortgage rate you get for a couple of weeks or perhaps even a couple of months. So that's my outlook right now as we sit in 2024. And of course, I could be wrong. And I know this isn't the news that a lot of people in the industry want to hear, but I want to just give it to you as straight as I can as I try and read the tea leaves and give you my honest opinion about where mortgage rates are going. And hopefully that helps you make an informed decision, whether you're trying to purchase a home, manage your portfolio, look at a refinance, buy a new deal, whatever it is, try to be as informed as possible. Thanks for watching. If you have any questions about this video or about mortgage rates, you can always hit me up on BiggerPockets or on Instagram, or I'm at The Data Deli. See you again in a couple days.